Everyone, I have a special guest with us today, Lyn Alden. Thank you very much for coming on.
Thanks for having me. Happy to be here.
So, you were one of the most requested guests that we have. And of course, right now, there are so many questions that have been submitted from the audience. We're only going to be able to get to a handful. But I wanted to start with the most taboo subject right now, and that is inflation or deflation. Where do you see it going?
So we've had a pretty significant period of inflation. And I think the biggest mistake that people could make is kind of thinking it as one big thing, whereas really it's a series of multiple things. So earlier this year, we had commodities, specifically lumber, that sort of thing was responsible for part of the inflation that has rolled over. Next, we had partially due to semiconductor shortages and other supply chain issues, we had used car prices skyrocketing. That's a pretty big, that moved CPI pretty significantly. That seems to be rolling over. The next thing I'm watching for is rent inflation. And so if you look at, if you map home price increases, then you put owner's equivalent rent and rent of shelter, those sort of metrics with an 18-month lag, those tend to follow. We're already seeing that in some of the faster updating data, some of the rental sites that kind of track new rent changes. So I do think that we're probably going to be pretty sticky with in terms of inflation as we go later into this year. But I think we're roughly at kind of near the higher end of the range we're probably going to see here in 2021. Could get a little higher, could get a little lower, but really it's about shifting categories of inflation under the surface.
And sort of there's a thesis that we will see heavy levels of deflation in asset prices. Is that sort of your viewpoint, let's say in the next 12 months, 18 months and beyond? Or do you think that asset prices may continue to increase, whether that's stock markets, whether that's the global real estate markets?
So it is a significant risk, and there's different pockets of excess in different markets. So the United States, historically, our stock market is more expensive than our housing market, although the housing market kind of caught up over the past year and a half. And if you look at the stock market, it's not one of those things where every single stock is expensive. There are value stocks out there still. There are many stocks trading at below their average valuations, but those tend to be in sectors that investors don't care that much about, like certain healthcare companies or say midstream energy companies, things like that. Whereas most of the desirable companies are trading at abnormally high valuations, and so there is a significant risk that as we get further away from fiscal stimulus, right? So the consumer has less spending power, and some of these excess valuations on the market, partially bid up there by retail investors that received fiscal stimulus. That does have a pretty significant risk of rolling over. Nothing's really assured, but basically the risk reward ratio is less attractive now for equities and real estate than it was a year ago.
I have this theory that I talk about and that I've been working out inside my head that if we do see a deflation, perhaps as a result of the Fed taper, as you know, maybe coming soon, perhaps an increase in interest rates down the road, and that the response may be from the fiscal side more directly, or perhaps even from the Federal Reserve, but directly towards people to give them money in their bank accounts like we've never seen before, like a UBI, something to that effect. And I'm wondering if you think that we could see persistent levels of real price inflation as a result of that, if you even think that that's something that will occur.
I think that there's a range of programs like that could occur. It'll partially depend on what happens with 2022 elections, right? Because if they get gridlocked, you're less likely to have those programs if they say if one party controls the presidency and the both houses of Congress, then it becomes more likely for those sort of programs. And so basically the way I'm kind of modeling this is that the Fed seems to be like they're ready to taper, but that inflation is already over 5% officially. And if you look at where the Fed's interest rates normally are when inflation is hot, they're already way behind the curve, and that's partially because there's so much debt in the system, and the economy is so financialized that if they crash asset prices, and if they make debt become more unserviceable, that actually can lower GDP. It's like the tail wagging the dog. Basically, if asset prices fall far enough, that can affect consumer spending, and that can trickle into GDP, where it's kind of supposed to be the other way around. but that's where we are at this point. And so I do think they're getting ready to taper. They're probably going to start slowing down their rate of QE. So still hyper dovish, it's just a little bit, marginally less dovish than they are now. And then we'll see, how long that goes before, they'll try to maybe increase interest rates either late next year or the year after that. But at any point along that timeline, they can get thrown off by a downturn. And that's what happened to them back in, say, late 2018, where they were trying to tighten both in terms of their balance sheet and in terms of their interest rates, and all these market forces, especially credit markets, basically told them that it can't withstand that. And so I think they're going to find a similar outcome, but it remains to be seen how far it'll go. When we do have the next downturn, there probably will be another round of fiscal support. But again, that could take different forms based on what politics looks like at that time. And so I do think that due to how levered the economy is, I think that they're going to keep erring on the side of effectively printing money when there's a downturn. But that doesn't necessarily elevate all asset prices. Certain types of asset prices can stay elevated, whereas other ones might actually have a more prolonged downturn.
Right, absolutely. I've heard from so many people that have said there is no chance the Federal Reserve is going to taper, give it up. It's not going to happen because they want to support these asset prices forever. They want that growth to be substantial forever. And my thoughts are simply to look at history and see how they've done this before. This wouldn't be the first time they've tapered. This wouldn't be the first time that they would have increased interest rates. They do these cycles and they're trying to effectively create a soft landing and so on. But I'm just wondering if you might expand on that a little bit and what your thoughts are for the taper specifically.
Yeah, so I think long term, their taper is going to fail. How far they get into that, it remains an open question because it'll depend on all sorts of things related to lockdowns, related to Chinese credit cycle, related to, again, 2022 elections, any sort of fiscal decisions. But basically, if you look at where the market is now, so QE, that adds liquidity into the market. But they've added so much that now, the market's kind of full of liquidity. And so actually liquidity is coming back to the Fed in the form of reverse repos. So it's not very effective anymore. It's kind of like, I've used the analogy, if you fill up a cup with water and it gets to the top and you keep pouring it in, it just spills over the side. And so if you actually stop pouring water in, it doesn't actually empty the cup because it's already full. And so when they try to taper, it certainly could have psychological effects. But the first few months of tapering shouldn't significantly impact liquidity because it's already kind of brimming. Instead, I think the more meaningful thing that will affect markets is the lack of fiscal, right? So we had, if you look at, generally what QE does, it doesn't really get to the people directly. It just goes into the banking system. It exchanges, they create new reserves and they exchange those for treasuries and mortgage-backed securities by the banks. And that really stays in the financial system. It doesn't increase broad money supply. But if you combine that with fiscal spending, which is what they did back in 2020 and early 2021, that goes out into the broad money supply, out into people's pockets. And so it's the lack of that I think is more impactful for equity markets and for GDP growth than the Fed's decision of how much asset purchases they're going to do. Now, if they eventually go long enough, eventually they can tighten enough that they actually start doing liquidity issues, and the market, basically punches them in the face and has them reverse it.
Do you think there are consequences to all their actions when we're talking about the Federal Reserve, and of course when we're talking about on the fiscal side with the government stimulus? Do you think that there are negative consequences to this down the road, not just in terms of the total debt, but the way I look at it is they're kind of desensitizing the whole situation, making it seem like, look, if there's no stimulus, how can there be any growth anymore? It's almost like, okay, when there's stimulus, there's growth, and then, well, they just have to do more stimulus because we won't have growth. It's almost like a self-fulfilling prophecy in a way.
Yeah, I would say, a lot of their mistakes happened in the 80s, 90s, and early 2000s under Greenspan when he had a choice. There was not that much debt in the system, and he didn't have to lower interest rates as much as he did. But by lowering interest rates, he promoted all these bubbles and debt accumulation. And now they find themselves where, they can't get out of that trap. They've already increased debt so much that they can't really raise interest rates enough before crashing everything. And so now it's kind of like, each new Fed chair is kind of just, moving chairs in the Titanic a little bit. They're kind of, they don't want it to crash under their watch. They're trying to kind of, smooth that landing. But that, of course, zombifies the economy, makes it less dynamic, makes it so that we can't get rid of unproductive businesses to, reallocate those resources towards productive businesses. And so that's the main kind of downside. In addition, you pretty much hurt savers because, until this past year, we haven't had, say, much official CPI inflation, but we have had asset price inflation. And for people that are holding their cash in the bank and they're earning a lower interest rate than the inflation rate, and especially compared to the broad money supply growth rate, they're basically losing out on asset purchases. It's kind of forced everyone to be a speculator and investor rather than a saver. And investing is a good thing. I've been investing since I was a teenager. But it is a problem when everybody feels like they have to invest everything in volatile assets in order to have a non-negative real return. And so that has all sorts of consequences when eventually if you have a significant bear market, you've pulled everyone in, right? Currently we have the record high household allocations to equities, and that's partially because equities have just done so well. Simply by holding them, they go up as a percentage of your net worth, but also because it pulled people in. It pulled retail investors in. It gets everybody in because there's no alternative. And then when they reach some kind of level that becomes unsupportable, if they start going sideways or down, everyone's kind of trapped at that point. And so there are a lot of consequences to this sort of thing, and there's not a lot of good options that they have at this point because they can, if you try to stop it, they're going to have massive crashes. And if they keep it going, they're going to potentially risk inflation, particularly on the fiscal side, not just QE alone, but the QE combined with the fiscal spending, in addition to continuing to promote these bubbles and speculative behavior.
And that brings me to the next question I have, and really it's two-part here. Many people have asked me about the gold situation as well as the SDRs. But first I want to talk about gold and where you think it has a place in, number one, people's portfolios, if any, as well as the global monetary system. So if you wouldn't mind expanding on that.
Yeah, so I think gold can replace part of someone's bond portfolio if they don't mind some of the volatility. Basically, it's something that on over the very, very long term, it should underperform equities, but it generally keeps up with T-bills and things like that. And so, particularly in environments of negative real rates, gold becomes arguably more attractive than holding cash and treasuries. And so, in an environment where you have treasury yields are higher than the inflation rate, then there's a high opportunity cost for owning gold because gold gives you zero yield, it keeps up with inflation. Whereas treasuries, if you're earning a positive real yield, you can compound. But you're in an environment like now with negative real rates, gold becomes a more attractive placeholder for a portion of a portfolio. I would say part of a bond portfolio, for example. As it relates to global assets, global reserves, the advantage there is it's a non-sovereign currency essentially, and it's kind of inherently inflation adjusting because if you look at gold's global inflation rate, meaning how much is mined per year compared to how much is estimated to exist above ground, it averages about 1.5% per year over the past century. And that fluctuates in a pretty narrow band between about 1% and 2%. So even when we try to mine more, we really can't get it much above 2%. And so you're comparing that inflation rate compared to the money supply growth rate, broad money supply growth rate of all these other currencies, which is often 5, 7, 10, 15% a year. And so gold has tended to appreciate compared to these fiat currencies. In addition, if you're holding gold, you can't really be sanctioned against using it. You can't be blocked from using it. And so it's been attractive to certain countries like Russia that have been seeking to de-dollarize. And so they've been focusing on gold and euro-denominated assets, a little bit of Chinese denominated assets, but mostly the gold and euro. We see still a number of emerging market banks like to hold some of it. And it basically gives them just more flexibility than only owning dollars. They can own a couple of different currencies, and they can also own this neutral, lower inflation currency, which is essentially what it is.
And for the part of the question related to the SDRs, do you think that, there's a lot of talk about the IMF SDR becoming the reserve currency perhaps, or maybe some sort of gold backing behind there. And, there's a lot of speculation essentially about what the next monetary system will bring, what the next new reserve currency will bring, and any thoughts you had around sort of the SDR type model.
So that remains an open question. We are seeing a significant increase in SDRs this year. And so they've announced something like a $650 billion increase, which is, it's not a huge amount in terms of the global monetary system, but it's a very significant increase compared to the relatively small amount of SDRs that exist now. And for people that are not familiar with the history, back in Bretton Woods, 1944, they were discussing two different systems for how they were going to organize the monetary system. The UK proposal was to have something called a bank board, which is basically what the SDR is now. And so they said, the international unit of account should be this basket that consists of a few different currencies and maybe throw gold in there too. There are a couple different formations that could have taken, and that would have been this kind of neutral unit of account that all currencies are kind of pegged to and used as their unit of account. The United States approach was, no, we want the dollar to be at the center of the system, so we'll peg the dollar to gold. Other currencies will peg themselves to the dollar. And that's the system that ultimately won out. And the problem, of course, is we eventually didn't have enough gold to maintain that peg, right? So we kept increasing the number of dollars. That whenever they'd redeem it, our gold kept going down. Eventually, we had to say we can't support that anymore. Then we shifted to the petrodollar system, where we made deals with OPEC, Saudi Arabia in particular, where we said, okay, only sell your oil in dollars, regardless of who's buying it. Japan, France, whoever's buying your oil, only sell it in dollars. Take those dollars and reinvest in our treasuries, and we'll also give you attractive arms deals. We'll give you protection. We'll protect your supply chains, but just keep only selling it in dollars. And so that basically indirectly backed to the dollar buy oil, not in a pegged sense, but in a sense that any country that needed oil needed dollars unless they can produce all of it domestically. And so that's basically the system we've been under since the mid 70s for about almost 50 years now. And so that system, the downside there is that unlike the Bretton Woods system where we had to draw down our gold reserves to maintain it, the way this system works is that now there's all this global demand for dollars because they need it to buy oil. And so that bids up the value of the dollar, makes our exports less competitive, gives us more importing power. So the United States runs these big trade deficits with the rest of the world to get dollars out there. It's not really a choice on our part. It just kind of happens. And so we draw down our manufacturing base, our industrial base. We kind of hollow ourselves out, but we extend our reach globally. But that's starting to run into these growing pains where, back when that system was put into place, the United States was 35% of global GDP. We were the biggest commodity importer. So it made sense to, arguably price all those commodities in dollars. But now the United States is like 20% of global GDP. China is the biggest commodity buyer. They're still doing it in dollars. And they're saying, wait a second, we're the biggest customer for some of these countries. Why are we paying in dollars? And so we're also seeing that, Russia, for example, they're vulnerable to sanctions. So they say, we're going to de-dollarize. We're going to sell our oil in euros, partially to China, partially to Europe. And so we're seeing more diversification and we're kind of moving away from this petrodollar system. Kind of behind the scenes for several decades now, they did eventually launch those SDRs, which are essentially the Bancor idea. It just never really took off. Basically, those are a basket, a unit that consists of 5 different currencies, and they're basically the 5 biggest currencies in terms of trade, and they're weighted by size. So the dollar is like 40% of the SDR. Then you have the pound, the euro, and the Chinese, and basically there's 4 other currencies in there. And so those are kind of a decentralized unit of account. And there were some countries previously that pegged themselves, their currency, to the SDR, but it's just never really took off that much. But we're starting to see it now where we're seeing an increase in SDRs. We're also seeing an increase in just general diversification in currencies you can buy oil in. And so whether or not it moves in the SDR direction or simply a more diversified reserve basket, right? You could have move from the current global reserve currency system to a regional reserve currency system where, it might make sense for some countries to hold more dollars in their reserves because they do more trade with dollars. And then if you look at Eurasia, it could make more sense to hold euros or renminbi in your reserves because you do more trade with Europe and China. And so I think that's the general direction we're going in, is different types of decentralization. We're also seeing ever since around 2008 uptick in the amount of gold held by these central banks. And so that's also part of the decentralization approach of having less, outright dollar exposure and more of these broad types of exposures, either SDRs, gold, or simply holding a diverse basket of different assets.
Very interesting. One of the last things that I wanted to discuss here was, of course, about cryptocurrencies. And there's a lot of debate on this topic, of course. And what I really think when I look at the arguments and I see the data and everything, there seems to be two very different sides of it. And often what we see is people arguing about the price, where the current price is, where the potential future price is. But there doesn't often seem to be taken into account the technology itself. So it seems to be more so about bullishness or bearishness based on the price, but not in like an actual utility of using the cryptocurrencies and how beneficial they could be versus our current monetary system and the way that we use money today. One of the arguments I hear all the time is Bitcoin is slow, Bitcoin is expensive. And these are arguments that are from people that clearly do not send money internationally. Because for myself, I send money internationally, and I'll tell you right now, this is not cheap and it is not quick. Okay. It takes time. It takes time to move money across, overseas, and it's not cheap. Okay. So when we're talking about something that happens in a few seconds, this is not something that's slow. I mean, compared to certainly maybe other cryptocurrencies, it could be perceived as slow, but we have to compare it to the current monetary system. So, first of all, in terms of the price of Bitcoin, price of Ethereum, price of any of these other cryptocurrencies, do you think where we are today in general is due to a lot of the speculation that we're seeing? Do you think that this is because of new money flooding in from the institutional investors, and sort of where do you see the future? Not necessarily I did have a few people ask me to ask you the price prediction for Bitcoin end of year. Of course, you're free to answer that, but I think it's more, what is the current price scenario? Is that something that is just purely based on speculation, or is this just the way it is now?
So we reached a pretty significant period of speculation back in the springtime, especially in some of the altcoins, right? So Bitcoin had, it did very well, but you saw, things like Dogecoin go vertical, right? So that's where a lot of the retail speculation was. And so ever since we had that big correction, I considered the space to be more reset, especially Bitcoin. And so, I think longer term, some of those alts will underperform when we have a deeper, longer bear market. I don't necessarily think that this current, bull cycle is over. I think we could see higher highs in assets like Bitcoin and Ethereum, maybe some of the others into year end or into the first half of 2022, for example. I mean, obviously that's subject to all sorts of macro conditions, liquidity conditions. So that's not a guaranteed, but I consider the current Bitcoin price approximately fair. And, the way I arrive at that is just by looking at the long-term adoption curve of it, some of these long-term price models. I also compare its market capitalization to estimated gold market capitalization, right? Because it's kind of fulfilling a similar niche, not an identical niche, but a similar niche. And so we're seeing how much total addressable market this has compared to existing stores of value that are outside of the financial system. And so the benefit of Bitcoin really is that you basically are, you have the most energy behind it, meaning that it's the most secure blockchain in terms of, someone trying to change it. Ironically, if these other versions of it, say Bitcoin Cash, you have to wait for more confirmations in order for your transaction to be considered, most likely final and unlikely to be reversed with a block reorganization, because it has a lot less energy in the system, a lot less, mining hash rate that's being directed at it. And so really Bitcoin's kind of approach is mostly deliberate in the sense that the reason it's slow and the reason it's expensive is because they wanted to keep block sizes small so that anyone with like a normal laptop can audit the money supply and validate their own transactions. Whereas if you increase the block size too much, you can increase throughput, you can increase the speed of the system, but then you make that harder to verify your own transactions. You have to rely on a distant server to tell you, whether or not the transaction went through, and it starts to approach more like fiat currency. And so Bitcoin makes kind of known trade-offs in order to optimize security over speed. Now there are other developments like Lightning Layer and things like that potentially offer faster payments when you're less inclined towards rock solid security, and you're fine with a different security model for more speed. So there's kind of a trade-off there. We are starting to see use cases in places like, there's an article in The Guardian about Nigeria, for example. That's one of the highest places of adoption. They've had high inflation when governments are doing capital controls, and some of those merchants were using Bitcoin to buy services and products internationally. We also saw, for example, when there were protests against the government, a lot of the protest groups had their bank accounts shut down, so they resorted to Bitcoin. It's just kind of that freedom tool that a number of different groups around the world have kind of resorted to. Now, overall, the space, the problem is that anyone can create their own cryptocurrencies. So when we see bull markets, all these copycats start to come in, capital gets diffused among tons of different projects. And so that eventually kind of, depletes buyers and eventually causes kind of a blow off top. And eventually you have a longer correction, and you sort out which cryptocurrencies are actually providing value and which ones are not. And so right now we have 10,000 cryptocurrencies. Most of them probably won't be much of value 5 years from now. A handful probably will be. So I think Bitcoin will be. Ethereum, good chance that it will still be valuable. But the smaller and more fringe you go, the less likely it is that cryptocurrency can be around in an attractive form. And so I think there is a lot of useful technology here. Like you pointed out, if you're sending an international wire, it can take a long time. It can be expensive. You can have hassles where just the bank says no, or just you lose track of where that money is in the system, and then you're worrying about which bank actually has this. Who do I call? Whereas blockchains can do international settlements depending on which one you're using. Maybe half an hour, maybe an hour, maybe quicker if you're using one of the faster, less secure ones. And so this is really interesting technology, both in terms of Bitcoin, in terms of stable coins, and in some of the other things that the system provides.
So the last thing that I wanted to ask you today was surrounding risk. So there's an unlimited amount of different potential risks to the financial system today, to the stock markets, the housing markets, and everything. But where do you think is the most likely or the weakest point of the markets today? Is it something with the commercial mortgage-backed securities, like I've been talking about extensively on the channel? Is it the price of certain tech stocks, like a 2000 type event? Where do you see sort of that biggest risk today?
I think that because the markets are reliant on low interest rates and basically continued support, a lot of these valuations are unsustainable if the Fed tries to taper. The first initial round of tapering shouldn't theoretically affect things too much, but it can psychologically. But the further they get into it, when they actually start to withdraw liquidity, these valuations are pretty hard to support. We've also had that feedback loop where, like I mentioned before, the U.S. runs these structural trade deficits in order to support the petrodollar system. And what happens is, those entities get those dollars. They used to buy treasuries, but they don't really buy treasuries that much anymore. Instead, they go in and buy U.S. stocks. They buy U.S. real estate. And so we have this kind of loop coming in where our trade deficits go out to the world, all these dollars get out of the world, and then they come back and buy U.S. assets. And so actually our increasing percentage of our assets are owned by the foreign sector, and also is helping to prop up valuations. And so if that flywheel starts to reverse, the U.S. equity markets are more expensive than most of our peers, even adjusted on a sector by sector basis. And so we can see some pretty significant downward pressure if international markets lose interest in our markets for any number of reasons. And so I do think that this is going, I think volatility is going to increase in the years ahead, and that this, we've almost been straight up since March 2020. And I think that's going to be facing more turbulence, and you're going to have to be a lot more careful about the type of equity that you own. And so I think that there are still high quality equities trading at reasonable valuations out there. There's real value. There's real work being done. On the other hand, there are meme stocks. There are overvalued tech stocks. There are, speculative cryptocurrencies, all sorts of things that are much higher valuation than they probably will be in the longer term. And so there is risk of permanent capital loss kind of spread out in pockets around the whole market.
Excellent. Well, I wanted to say thank you very much today for coming on. Where can people find out more about you, your services, and everything that you have going on?
So I'm at lynalden.com. Most of my content's free. I also have a low-cost research service, and I'm on Twitter at Lyn Alden Contact.
Perfect. Well, from myself and from my subscribers, thank you very much for your time today. Perhaps 6 months down the road, we can do a follow-up and see if how things have changed.
Yep. Thanks for having me.